Hey, Barry, it's great to see you. Thanks for taking the time to spend with us today. Much appreciated.
It's always such a pleasure to be with you, and I enjoy every one of the podcasts that you do. I read on my radar every week. You always have amazing insights, so it's an honor to be with you again, my friend.
You are awfully nice. Hope your Christmas was great and moving into the new year with some fun celebration coming ahead for you.
Thank you. I'm looking forward to 2024. You know, the industry that we predominantly serve is mortgage and real estate. You know, we're involved in all aspects of the market, but I almost feel like it's like you watch Squid Games, right? I'm telling people, congratulations, you've made it to the next round. You know, if you survived 2023 in mortgage and real estate, it's kind of like you went through Squid Games, but now congratulations because you made it to the next round. So that's a blessing that you have. You know, Steve, it's interesting, quite a few people, nearly half of people in the mortgage industry did not renew their license. So unfortunate, we wish
Wow.
them good, but you could see how difficult it was. And a similar story on the real estate end. A lot of people got in when it was hot. And now that real estate values have remained very strong, it's the amount of transactions. That's people get confused with that. So those amount of transactions significantly diminished.
Right.
So while many people didn't make it, and we wish them well, those that survived, it's a good thing. But now your competition's even more fierce, so you really have to be on top of your game.
Wow. So let's go back and look at 2023. Your calls on inflation, spot on. The performance expectation for the real estate market, pretty much spot on. Let's talk a little bit about that. And I want to go through thinking in terms of inflation for 2024, your thoughts around that. Talk about the mortgage market, the real estate market, direction of interest rates, and let's cover the gamut.
Yeah, let's do that. Here, there's another one that we did say, you know, we had three forecasts that would, you know, we kind of put our hat on there. And the one that we missed badly was on mortgage rates. Now, I did think that mortgage rates would get into the fives. I thought we'd be lower mortgage rates during the summer. I was completely missed that one. There were reasons for that. The reasons for that were because in just around the time we thought they'd be coming down, as you recall, in June, that debt deal that was put together. We had $2 trillion of paper that was issued, and the Fed became less accommodative than we thought they would be by continuing to increase interest rates at a time that inflation was coming down significantly. You know, you and I did a podcast together. We said that I forecasted to you, and I think you were kind enough to put it on our radar, that we thought that while inflation at the time was 7%, said CPI should be 3% in June. And wouldn't you know, it happened to just fall exactly 3% in the June reading. So we got that one right. But based upon that, I said mortgage rates usually follow inflation, so they should be coming down. Well, that didn't exactly play out. But now that things have settled, we've absorbed some of that debt, and the Fed has become less restrictive and leaning now towards more accommodative as far as their dialogue goes. We are now starting to see what we anticipated happening, albeit 4 months later, that it started to occur. But that trend is actually materializing now. We thought it'd be in June, and it's kind of in October is when it started. But I do think the good news is it'll continue. I've got some charts, Steve, if you'd like me to share with
Oh,
you.
pull them up.
All right. So I'm going to go fast here. So we're going to do this like, you know, rapid fire here. So I think 2024 comes down to supply and demand on a lot of these things, as it does typically with marketplace. So let's talk first about inflation. You know, we did say that 3% in June, and it was at 7 when we made the call, but sure enough, exactly 3% in June of 2023. But where is it going? More importantly, well, core CPI is at 4%, core PCE is at 3.2%, and the Fed wants this core PCE target to be at 2. That's what they would like it to be. 41%, 44% of CPI, 21% of CPE core is housing. It's the shelter component. Shelter is comprised not of home values, not of home prices, but of rent, actual rents, and owner's equivalent rent. So people look at the apartment list rent. The problem with that one is, while it's great data, it's only on new rents. That's actually negative year over year. You have to go with a blended rent, which incorporates renewals. So we're looking here at CoreLogic's blended rent, and year over year, it's 2.5%. But the way the Fed looks at it, it's really wonky, Steve. And it's almost clandestine the way they do it. They go and they look back 6-month chunks, but they pick up most of this data in January and February, which means it gets reported in February and March for the past 6 months. So I anticipate when we get the February and March data, we will see a catch up there. But for now, what we're looking at in the readings from CPI and PCE is they're coming in respectively, PCE 6.7%, CPI 6.5% year over year. So as you can see, there's a lag here. If you took this and kind of averaged back a little over a year, that's where this would be. So the real-time number, you have to kind of average the last year to get what the Fed looks at in its inflation calculations. Now,
They're
hopefully
6
the Fed's
months behind.
smarter. What's that, buddy?
They're 6 months behind.
Almost, yeah, 6 months, maybe a little bit more, because then you take into consideration when did you sign the lease. Could be something that there is a big lag. I think, Steve, that you can then take this and almost do the math and say, okay, so take these numbers, subtract the 2.5, you got 4.2, multiply it by the amount of weighting, and you could see what the actual numerical lag effect is. So a real-time number for inflation would be 2.2% on CPI core, or 2.3. Now that's a lot closer to the Fed's target. And one of the key statements from the last Fed meeting, where during the press conference, Jerome Powell clearly said this, and it was wonderful to hear him say, we will not wait for the 2% target to be hit before we start cutting rates. So I thought that was very wise of him. He was pressed for a number, and I think he wisely declined to give an actual number of when they would start cutting interest rates based on what they see in core PCE. But as you can see, we are certainly going to be headed lower. And one thing that the Fed, I think it was 2 press conferences ago, that he said that they'd look very closely at the 6-month trend. So they take the last 6 months, total those month-over-month readings up, double it to give you an annualized year-over-year reading.
Mm-hmm.
He looks at that closely. That number, and it gets in so little press, but it's so important. Nobody looks at this, Steve, but the Fed said they do, so that's why I think we should. 1.85%. So if you look at the last 6 months, core PCE it's really, if you take the last 6 months, it's 0.975. So you double that, you get 1.85%. So we're below 2% on a 6-month annualized reading. Okay, so what can we anticipate? Well, we know shelter weighs so heavily, right? So let's look forward now. Let's all try and forecast. So let's look at what was inflation in December of 2022 for shelter for that month. And now it will be replaced by the December reading for 2023. We get that release on January 11th. So that's the way this looks at. This is what's being replaced. The December reading will replace it for 2023. We get that January 11th. And as you can see, look at where it was. It was almost 0.8%, 0.79%. We've been trending in here. So we should see a nice bump. Same thing for when we get the release for January, which comes out February 13th of 2024. And March of 2024, we get the February release. It will replace the February 2023. All these are up there readings. So I think we make a lot of headway on core PCE and core CPI. I think we will get friendly bond numbers on January 11th, February 13th, and March 12th. I think you'll see good readings in the bond market for inflation. The stock market should like it. It should mean that the Fed will likely be looking at the reason to cut. And let's remember, the next Fed meeting after this is March 20th. That's why the odds are so high of a Fed rate cut, because this all makes sense that we'll get lower inflation. Now, you can see after that, Steve, this will not be as much of a tailwind for us. It'll probably be more neutral. So the bulk of the ground that we're going to make up will happen early in the year. So as we see the rest of the year, it's not as friendly, but it's not bad. All right. So the Fed wants to get to 2% core PCE. Let's do math, Steve. How do we get there? The current year over year is 3.16%. So as we look at that 3.16% PCE reading, here's what we think in our forecasting. We think December, January, and February's numbers, the December 2023 comes out at the end of January. We think that there'll be 1/10, 1/10, 1/10 because of that very favorable chart I just showed you here, which shows you that we'll make up a lot of ground. So as we take a peek, looking forward, what's going to be replaced? These numbers in CPI will be replaced. So now if you take 3.16 minus the difference here, so we're going to gain 0.29%, the PCE reading should be at 2.87. The Fed will see that at their January 31st meeting. Might be too early to cut. But March 20th, they're going to see these readings here come in like 2.5% on inflation by May 1st will be at the Fed's target. That's why the chances are so high. And you could see it looks like we're heading to under 2% year over year PCE. So that's why the Fed is thinking we've got to become less aggressive, more accommodative, and we have to start thinking about this. So let's think about what's in the mind of the Fed. Well, right now the market's handicapping a 90% chance of a cut March 20th. And for all the reasons I just showed you. So we're not the only ones thinking about this. Certainly some very smart quants are looking at this. But I think, Steve, when you look at, okay, 90% chance of March 20th, I think what we just looked at is why we're getting a 90% chance of March 20th. These are the reasons. And it looks like 90% that we'll get at least 50 basis points by May and 75 basis points by June. 91% chance of that. So good. So what's the Fed telling us? Here's their dot plot. There's 19 Fed members. They anonymously put a dot plot here for each one. So this is where they think. You got two of them. Hello, Michelle Bowman. Hello, Michelle Bowman. That's where she is right there. The governor who had no business experience except working at mommy and daddy's bank in Kansas. So, she's not in Kansas anymore, though. Unfortunately, she's at the Fed. So she really doesn't understand this because she's a lawyer. But what we see here is we have a lot of Fed members who probably do see this here. And you can see that they were looking at 75 basis points, but I think it's got to be more than that. However, look at what we can expect here. If you're a bond market fan, look at what the Fed's telling us, that you've got some good times ahead. Hey, if you're in mortgage and real estate, right? You survived, and now you should get tailwinds going forward because the trend from the Fed is down. Here's an important thing about the Fed. They try and forecast unemployment. So 3 Fed members think it'll be between 3.8 and 3.9. 9 Fed members between 4 and 4.1. Now, we know the unemployment rate currently is 3.7, but Steve, I think it will go up. If it gets to 4.2%, what happens? 12 of the 19 Fed members are going to say, oh my gosh, I wasn't seeing that in my bingo card. So now let's rethink this. I got to get more aggressive. That's why I'm thinking you're going to get more Fed rate cuts because Fed members, 12 of the 19, will be surprised, in my opinion. They'll have to get more aggressive. We'll have to see more Fed rate cuts. So here's Janet Yellen's piggy bank, the reverse repo market. So listen, Steve, banks have to buy some of these treasuries. So Janet's peddling these treasuries. We're in a lot of debt. Please buy them. Banks say, no, I'm not going to buy them. And that's why yields went up. So why did banks not buy them? Steve, think about this logically. If I'm going to invest in a treasury, but the Fed looks like they're going to continue to hike and rates are going to continue to go up, why would I lock into a rate that I know in the coming months will be less than what I could get if I were waiting? So what did they do? They parked money at the Fed because essentially they were able to keep up with the Fed hikes. So that's why we saw this move up. You could see from nothing in 2021, it started to increase, and we went to $2.5 trillion. Now, when it peaked, it was because the mantra from the Fed became a little bit less negative. Bill Ackman timed this beautifully. He was cut off his shorts. That didn't sound right. Yeah. He stopped his short position in long treasuries. This was great for Yellen and the Treasury to fund debt. But banks then said, hey, we now are seeing a peak here. We'll start buying treasuries. And they took money out of this piggy bank because it was just parked here, and they started buying treasuries. But look at the precipitous drop. This piggy bank has gone from 2.5 to $800 billion. What happens as this gets less and less and less? I spoke to Lacey about this, and Lacey says, Barry, I think you need at least 200, 300 billion for banks to perform their facilities that they have to. So he thinks we're close to, over the next few months, this running out. This is where Janet Yellen has to turn around to Jerome Powell and says, hey, Jerome, you got to ease up on the quantitative tightening now. And that's the real key to what we're getting to, is the quantitative tightening is the key. I don't know whether Jerome Powell will do it or not. I think he's going to have a lot of pressure, both politically as an election year, political pressures mount, and from the Treasury saying, help us monetize this debt. So if he stops QT, that's where the fun begins for us. Let's look at the Fed's balance sheet. You can see it ballooned up to 8.5 trillion. Now, this is outright holdings of treasuries and agencies. It's come down by 1.4 trillion to 7.1 trillion. So the key is, when will the Fed stop pumping this, offloading from their balance sheet? When will they stop doing that? Because, Steve, that has a huge bearing on the paper that's available out there. It all comes down to, as I started, this supply and demand. So The average range in 2014 to 2018 was about 4.2 trillion on the balance sheet. While it's a lot less, it's all relative. If we look at what our average GDP was, it averaged about 22% of GDP. Pre-COVID, it was around the same amount. But I wanted to show you this. Notice how it went up, but because GDP went up, you could see the percentage came down. So the Fed was comfortable with this. But when the balance sheet peaked at 33%, because you got 8.5 trillion on $25 trillion economy, the Fed said, I can't do that. So here's where we are today. It's come down to about 25%. Our GDP's gone up. The amount on the balance sheet's come down. So let's try and do some math here. We know what they're offloading, and we can kind of guess where GDP will grow to. And you could start to see why that March 20th meeting now has a lot of significance, because the Fed might start cutting here, but they might say, well, you know, it's at 24, 25% of GDP, the balance sheet, it's at 6.9 trillion. Maybe the Fed might say, we'll cut, but we'll keep offloading the balance sheet. Now, that might be something like somebody driving a car, 1 foot on the gas, 1 foot on the brake, which seems counterintuitive, but eventually they'll have to slow down or stop QT. I think that they will taper it. The key is when. Notice here, as we get into the July 31st Fed meeting, we now start to get into a range where the Fed might say, I'm kind of comfortable about this. I won't stop QT, but maybe I'll start to taper it and more gently get into a comfort zone for the Fed. So I think the July 31st meeting will be very meaningful. The March 20th meeting, I think, is the first cut. But if they start to taper the balance sheet here, this has huge significance for rates and for the marketplace, because look at what has to be funded. We got a $2 trillion deficit. We've got new agencies which are deemed in the same asset class as treasuries. That has to be absorbed. And this is just purchases on mortgages. The balance sheet runoff adds to this. So the market's got to eat 4.2 trillion. But if the Fed just tapers a little, and that allows banks to start buying, you now start reducing the supply from 4.2 trillion to 3.3 trillion. That means things will be bought with both hands. More money could go into the stock market. This is just a good overall market indicator. Remember, in 2023, we had to have 4.5 trillion of this type of paper absorbed, which really caused rates to rise. But now just at the idea of this is causing rates to decline. So I think rates drop a little bit more. And then we can go into different areas of this too, Steve, but I just wanted to stop there.
Wow, that's fantastic. I've not seen it put together that clearly, concisely. That was really great stuff. Thank you for that. All right, so before you go into jobs, let's talk about so we know where you think inflation is going, still lower. We know we're talking about the Fed, 3 rate cuts, ideally. And then at the same
I think we'll have more than 3. I think we'll have more. I think we'll have 5, 6 this year.
And do you see a recession in the equation as part of that?
They moved the goalposts on recession, Steve, so it's hard to say. It seems to me that we will probably, I don't think we're out of the woods on a recession. It's hard to forecast. That's another one I did get wrong. I thought we'd get a recession in 2023. We didn't get one in 2023.
Oh, we got a lot more liquidity than we thought we were going to get.
We got so much more liquidity, and I think that's certainly what did it. You know, something that people don't talk about, that employee retention credit, that pumped so much money in, and there was, as you said, a lot of liquidity. So that kind of kept things going for a while. To me, whether we get a recession or not, I think the key will be the unemployment rate. If that unemployment rate reaches somewhere in the neighborhood of 4.1%, 4%, which I think it will, that will trigger something called the SAM rule, which tells us from the cycle low. The cycle low was in April of 2023 at 3.4%. You get a 0.5% or so average for about 3 months above that. So you average 3.9% for about a 3-month period. And you're pretty much, whether they call it a recession or not, you know, and remember, we won't know we were in a recession until months and months later, till the National Bureau of Economic Research tells us we were. So it's almost insignificant when they say we will be. At that time, it'll be old news. We may be out of it. But I think the key will be watch the job numbers. We get to 4.1%, 4.2%. A lot of things change. It'll feel more like a recessionary feeling. Rates will drop as if we're in a recession. The response from the Fed will be as if we're in a recession. So I think that holds the key more than the actual call, which will be yesterday's news.
I think you're so spot on. Mortgage rates.
Mortgage rates, I got it wrong last year, but I think we will be right this year. They have already started to come down. I think that we'll get into low sixes, high fives, because finally we will have the Fed stop being a headwind, the excessive debt and paper that has to be absorbed, that will start working in our favor. And I do think that we will see it. Look, rates did start to come down 4 months after we thought they would, but I think that we will continue, not in a straight line, to see a trend. Important stop for the 10-year treasury now would be 3.75. That's an important floor there. We get underneath that, we could start to see, last year we tested about 340 a couple of times. I think we should get down to that 340 level, but I would not be surprised to see us get in the range of 3%, especially if the key for me is supply and demand, and it's the QT that if the Fed starts to taper that.
That gets down to 3%. The 10-year treasury is probably down around 3.25, 3.5%. Mortgages, you're saying maybe mid 5% range would be a good target.
It
And
is.
then that's got to be very bullish for housing.
It should be. What we see now is we see people that, let's say you have a 3% rate, to go certainly to 8% is a bridge too far for most people. But people get it wrong on affordability. They just don't understand. I have a slide that kind of helps to explain affordability. So Steve, I'd like to just try and bring that up quickly, if I may. And I'm going to go through just, I'm going to skip some of these things. This is what I talked about. You are actually in a recession when you get a 0.5% above, and recession leads to this is lower mortgage rates. So we think it gets lower. This is what had happened. It was all the debt and the Fitch downgrade that hurt us. But we think the Treasury 3 to 4.25 should be the range for the year. I think it more closer to getting that 3, 5.5 to 7, 7 the high, but under 6 should unlock move up buyers. So let's talk about that. So we think we've been spot on this year for appreciation. We think next year about 5% you should pencil in. Inventory is a key. The supply and demand, again,
Yes.
The blue lines are households being formed, builders putting up homes in gold, too little homes being put up, too many people to have to need housing. So it'll put pressure upwards.
Let me have you freeze for a second. So household being formed, this is the demographics between kind of 31, 33, 34 years old.
Exactly right. These are just people that are forming at that household, that are moving out of mom and dad and getting their own place. So yeah, Steve, I've been showing this for years. That at the Malden conferences, I've been showing it, and it has been very reliable when we took a look. And this is why most people got it wrong on housing. Everybody thought, oh, rates are going to go up, housing's going to crash, and so many people have been. But fortunately, and this is an area I will take credit, we have been spot on housing. It's because we understand the fact that you need to look at demographics, you need to look at previous birth rates. It's all supply and demand when it comes to housing, and you need to look at what the future holds for builders putting up housing. And when you put that all together, and we try and do it simply here, it spells more appreciation ahead for home prices, even in the face of higher rates. And it's been so ridiculous. People say, I've heard this incredibly insane argument getting traction. Well, when rates come down, more people put their homes on the market, so home prices will decline. That's the stupidest freaking thing you've ever. Where do they think these people are going to move to? A tent? That if they sell their home, they got to buy another home or live someplace else. That's the demand on housing. And on top of that, did you know that for every 1% drop in rates, 1 million more people are qualified to buy? Certainly not all of them will buy. I'm sorry, did I say 1 million? I meant 5 million more people. 5 million more people are qualified to buy. They will not all buy, but they will be qualified to buy. So that's going to put more upside pressure. So as rates decline, there will be more upside pressure on home values. Take a look at what we see here. The media says this here, and this is really crazy. The median income needs to be 115,000 to afford the median home price of 420. That's based on a 30-year fixed rate of 7.5. Now we know rates have come down, so this income level has come down already, right? But this is the story that's being pushed out there in the media to get clickbait and try and scare people. But you don't get the median income. The median income in the U.S. is 75,000 currently, right? But if you remove those earning under 20,000. If you're, God bless you, you're 16 years old working at Wendy's, you're not a home buyer. You shouldn't be included in this equation. So then you just bump up the median income to 100,000. If you remove the households earning under 40,000, which most of them likely are not yet in the home buying process, God willing, they will be, but not yet, then the median income is 120,000. So the affordability myth that's out there, it's bullshit. It's just bullshit. Yes. Has it become less affordable? Yes. But mortgage rates are already declined and heading lower. But here's why. And this is, the media doesn't understand this because math is hard to do, right? But let's try and break it simple. take a monthly mortgage payment of principal and interest of $1,000 a month. That's a $240,000 mortgage at 2.875. Let's say somebody got that. Their monthly income needed to be $4,000 a month to qualify for that. Roughly, that's about the ratio. I know people say it's different, but that's if you include taxes and insurance. I'm just trying to make the numbers simple here that makes sense. These are the averages according to Fannie Mae, Freddie Mac. So let's just say you had some shock. Your rate went up to 6.75, and now prices went up too. So now you'd have to look at a $280,000 mortgage to increase to account for the increase in value and the increased rate to 6 5/8. That would be $1,800 a month instead of $1,000. That's an $800 a month increase. That's an 80% increase. People think your income needs to go up 80%. It doesn't. An $800 a month increase needs a 20% increase in income to offset it. Incomes have already risen 13% since 2021. That does not count the increase for this year. So we will likely see this become very, very narrow. I think by the end of 2024, affordability, not an issue, Steve. So these are all important aspects.
That's fantastic. That's fantastic, Barry. What a great perspective. And you're diving into the data really as deep as anybody that I've seen dive into the data. That's really fantastic.
We try and apply math to it too. We try
Yeah.
and apply math and
Well,
logic.
and
And that's,
logic. And just logic, because a lot of the quant models out there don't pull that out of it. So that's excellent. All right. So overall, somebody looking to buy a house, not bad, right there. This is still affordable, still makes sense. The general housing market, you called for kind of a 6.8%, 7% appreciation in 2023. What's your outlook for 2024?
I think 5% you should pencil in. Now, listen, Steve, that's not to say it's an easy home buying market. Okay. I'm not insensitive and I'm not blind here. Eyes wide open. We know that inventory is tight. We know it's not easy. We know it's expensive. And we know for some people it is less affordable. Certainly. I get that. But if you can buy a home, if you can, it's better than the alternative of renting, because your rent will go up every year. You can essentially fix that payment in. So it may be hard in the beginning, but it gets easier. You also are going to build equity. 5%. I mean, just do simple math. If you looked at a home that's $100,000 home, but I know you're not going to buy it, but I want to use for the math. If you put 10% down, you have to finance the rest, but that's going to be close to renting. So the monthly payment, either you're going to pay it in rent or you're going to pay it in mortgage. The 10% down on a $100,000 home, that's $10,000. So that's your investment. If you took that investment and said if the value goes up 5%, that home went up $5,000. $5,000 profit on a $10,000 investment, 50% rate of return. Plus you're building equity because you're amortizing your loan. So this is why, if you can, buy a home. And it's crazy to me how the media poo-poos home values going up. They're like, oh, that's terrible. Home values keep appreciating. We need more help. We need home prices to come. Really? Do you know 2/3 of people own homes? The 2/3 of people, would you be happier if your home value was coming down? Really? That would be, why don't they do that for the stock market? They cheer stock prices going up, but they don't say we need stock prices to come down to make it more affordable. The logic, it's crazy. Home values going up is a good thing. It creates wealth. It's healthy. And that's why people need to get on that bandwagon as soon as you possibly can. Because
what haven't I asked you that you'd like to relay? That's it. Any other topic?
Well, gosh, there's so much to talk about, and there's so much that I'm interested in, and there's so many things that you bring up and the things that you write about that are of incredible interest to me. I try and stay in my lane, Steve. I try and follow these things that I follow. I'll reiterate that I am optimistic about housing. I think rates come down. I think the Fed will be a tailwind. Watch the balance sheet. People do not talk about it, but that is going to be a big trigger. That's really going to be the key. Look, it all comes down to supply and demand. It's reason why I got it wrong on rates last year is because the supply of paper coming to the market, I did not foresee it because we didn't know the deal that was going to be cut between the Biden administration and Kevin McCarthy. We had $2 trillion of paper that flooded the market. Correct. Got it wrong. Didn't see it coming. So even though inflation was cooperative, rates did not respond until that got absorbed. So
that ceiling remains unlimited until
2025.
2025. Ugh. There you go. Barry, thanks a million. Really appreciate you.
Oh, it's a privilege to be with you, my dear friend. Thanks for all you do.
Yeah, that's great.